Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Aditya Sharma, who is our Asia head of FX strategy here at NatWest. Aditya, thanks for joining the podcast.
Thanks for having me, Eimear. So my question is that Xi-Trump summit was a highlight of the last week, but this week Xi hosted President Putin. So how did this summit compare versus the one we had with US last week?
Yeah, I have to say there was an eerie similarity between the two meetings between, Xi and Trump, which was just a week before, and then President Xi and obviously Russian President Putin. When you look at the images from, some of the ceremonies that went ahead, it was just uncannily similar. You had, the Great Hall of the People, a 21-gun salute. You had, the military bands playing both countries' national anthem, kids waving both nations' flags. So you do get the feeling that, she was bestowing the same diplomatic kind of ceremony and pomp on Putin that he was to Trump. And you have to kind of contrast that with how regular, the visits are. So for Trump, this was only his second visit to China, the first in nearly a decade for a US president. While Putin is a regular visitor to the country, it was actually his 25th visit, and yet he was greeted and kind of extended the exact type of honors that were to Trump. So there was perhaps, a subtle slight there for the US president. Also, some of the language was quite telling. So Xi at one point kind of railed against rampant unilateral hegemony in relation to one unnamed country, but you can kind of imagine who that perhaps was directed at. And although that might have been quite subtle, actually when you had the joint statement which came out between Xi and Putin, there was some very kind of blatant, quite aggressive language coming through, pointing to unilateral coercion, bloc confrontation, and undercurrents of neoclassicism. And they also went on to kind of give this fiery defense of the UN, an institution that Trump has repeatedly been a critic of and has even kind of threatened to remove the US from. It then went into kind of, firmly opposing using human rights concerns as a pretext for interfering in other nations' international affairs, which could be construed as a direct kind of argument against the US strikes against Iran and kind of starting that Middle East conflict. So I do think, in a lot of what we saw from that Xi-Trump meeting could really be construed, as a veiled, criticism or insult to the US.
And aside from the reflection of China-US relationship, what came out of this week's meeting with Putin?
Yeah, sometimes what I think is most interesting is actually what doesn't come out or what is not said. And I guess the big thing going into this meeting was the potential for what's called Power of Siberia 2, which is this proposed pipeline running from Russian gas fields all the way into China. So basically give China a second kind of channel for importing Russian energy. This has long been discussed, but if you would think that if there was any time when China needs or wants to secure an additional source of global energy supply, it will be now in the context of a Middle East war. However, it just didn't come up. It wasn't mentioned in the joint statement. It wasn't mentioned in any of the leaders' commentary. So it really kind of underscores how well China is positioned to actually, wear this global energy supply shock. China actually, 62% of its energy demands comes from coal. It sits on the world's largest stockpile. I think at the very end of 2025, it had 1.4 billion barrels of crude oil inventory, so well eclipsing the US, which had the second largest global oil inventory supplies. So it does kind of, reinforce China's ability to act as a safe haven for global investors when it comes to, how well positioned it is.
And we also had the key economic data from China this week. So what does it tell you about the health of the Chinese economy?
Yeah, it wasn't the most optimistic of reads. I have to say, retail sales, industrial production, fixed asset investments, they all undershot even the most pessimistic of Bloomberg forecasts. I would say the real surprise here was industrial production. Previously we've seen that exports and industrial production have really offset weak Chinese domestic demand. It really kind of provided a pillar of support for the economy. but these really undershot expectations. And when you kind of drill down into what industries were driving this, pharmaceuticals and mining, it does suggest that, China isn't immune to this global energy shock, that there will be, I guess, consequences in terms of a weaker run of activity domestically. Property sector at the other end of the spectrum was the one positive. We did have tentative signs of stabilization coming through. In the aftermath, there was a lot of talk of, whether this would be the trigger needed for greater stimulus coming through from Chinese authorities. I would say you did have a call from the National Statistics Agency, where they were clear that they were looking for fiscal as opposed to monetary stimulus. I think that's in line with what we're already seeing from Chinese authorities, is a greater emphasis on fiscal stimulus as opposed to monetary. The last thing they want to do is kind of, dramatically reduce interest rates, having, more leverage building up within the system. This is definitely kind of very long-term, very slow, very incremental stimulus that's coming through from China, really emphasizing that the emphasis is on stability for China policymakers. But Aditya, you certainly did not have a boring week in your space. So we had Bank Indonesia, who surprised markets with a 50 basis point rate hike this week. How do you really interpret this news? And I guess, what does it mean for the rupiah from here on out?
The hike by Bank Indonesia was clearly a surprise. Market consensus was for a 25 basis point hike, and it was a split between 25 basis point hike versus a hold. And I think Bank Indonesia wanted to retain that surprise element. A few weeks back, we had a rate hike from BSP, mostly to defend the currency and to decrease the pressure on inflation. But I think that did not support the currency at all. And I think BI would have considered that. And that's the reason they had this surprise element in yesterday's meeting. It did have the desired impact. Rupiah has kind of stabilized now, at least since yesterday, it's looking stabilized and it's gained slightly. But the fact is that I don't see that we would see a complete reversal for rupiah from here because of a 50 basis point hike from Bank Indonesia. The structural challenges for IDR still remain, the most important of which is, of course, higher oil price. And you had concerns about fiscal deficit target getting breached by the government this year. So that still remains intact, especially in the face of higher oil price. And the third fact is that Indonesian equities were viewed very cautiously by international investors before. A major index provider had cautioned about downgrading the status of Indonesia in emerging market index. And that had cautioned international investors. So outflows from Indonesian equities were already picking up. So I think these factors are still existing. Nothing has changed on that front. So a rate hike would maybe to stabilize IDR in the near term, but I don't think the medium term view changes. The other risk for me that I think is that higher rates are going to tighten financial conditions in an already slowing economy. And then it might accelerate equity outflows. So one important fact that was pressuring rupiah before was outflows from Indonesian equities. So if higher rates would have an undesired impact of exacerbating outflows from Indonesian equities, I think the impact of rate hike would actually be offset because of this.
Okay. And interesting, you talking about that link between equity outflows and currency performance. We had dollar, Korean won back above 1,500 this week. To what extent was that actually driven by, speculation of strike action at Korea's largest chip maker? And now that those kind of tensions and concerns have eased in the market, what are you looking for from the currency?
Korean won is driven by a mix of both global and domestic factors. The strike at this memory chip maker did add to a meaningful idiosyncratic risk premium over the last couple of weeks. At its core, I think Korean won is a higher beta currency. It's higher beta to dollar, and then it's driven by semiconductor cycles and the global risk sentiment. The global risk sentiment is, of course, negative at this point of time because of the situation in the Middle East. But we are going through a semiconductor upcycle right now, and Korean exports are holding up really well. But the fact that we would have probably seen an extended strike at this memory chip maker would have had added a risk premium and was leading to outflows out of Korea. The 20-day sum of equity outflows from Korea has reached a 3-year high now, which I think is driven partly because of the risk that investors saw of a strike at this memory chip maker. Now that the strike is suspended, I think this premium should fade away. But that said, the biggest driver is still the global risk premium.
Yeah, another currency that's really come under pressure recently is the Indian rupee. What's your outlook from here?
Yes, INR underperformance is largely driven by a mix of external factors as well as internal factors. INR, India is, of course, particularly sensitive to higher oil price because it's one of those countries that has highest imports of oil. And the other point is that equity outflows from India is also quite significant, and that's partly driven because of concerns that Indian IT can suffer a blowback from AI, and that could disrupt Indian IT services. And Indian IT, given that it has a huge composition in the index, because rupee has been depreciating, the other factors that exporters, I think, are likely holding back on FX conversions, while importers are increasing their hedges, trying to minimize the FX risk. That's reinforcing the expectation of further rupee weakness. And that's probably accelerated the pace of depreciation over the last couple of weeks. It surprised the markets and RBI as well, and RBI would clearly be uncomfortable with the pace of depreciation of rupee. And that's one reason it's very difficult to have a very strong bearish bias on rupee at this point of time, because it's highly likely that RBI could come in the market and disrupt the moves that we are seeing right now. Even today, we saw some headlines that RBI could probably consider a rate hike. So this is happening after BI's move yesterday. It's difficult to reconcile that RBI would do an off-cycle rate hike just to support the currency, because they have previously always said that their target was to control inflation and not currency. But RBI would be uncomfortable with the pace of decline now. The other point yesterday was RBI saying that it would probably increase liquidity in the market by conducting a swap operation. I think this is a preemptive move. FX intervention that RBI has been doing to curb volatility in the currencies is draining liquidity in the market. Liquidity is still in surplus, but it's declined sharply over the last couple of weeks. And RBI may be looking to intensify those operations going forward. And it might be projecting that liquidity could turn into deficit going forward because of its operation. So maybe it's looking to already inject liquidity into the market, despite liquidity being in a surplus state as of now.
Yeah, you really feel for these central banks who are having to, protect their currencies. Obviously, that risk of import inflation really compounding the inflationary concern already from higher energy prices, and I guess particularly in Asia, just that lack of energy supply. Aditya, thank you so much for joining me this week. That's probably all we have time for today. If you do like the podcast, please do click like and subscribe so you get the latest episode first. Thanks.